Hello everyone, and in this video we are going to discuss about the arbitrage pricing theory. So let's begin with understanding what is the meaning of this topic. But before discussing this APT, let's move back to history of this capital asset pricing model. In that model, we discussed the security market line theorem, that is the expected return, that is ER, is equal to risk-free rate of return plus beta multiplied by market risk premium. It's my request, if you have not seen the CAPM video, then please watch it. It will be really helpful to you. Now what we discussed that the CAPM model was the sensitivity of a stock in respect to the market. That was the definition of the beta. That, for example, if the market changes by 1%, then what is the change in the percentage of that stock? So that was we discussed in the CAPM. What was that market? That was a well-established benchmark index. That may be S&P 500 or it may be the Sensex or Nifty. But we discussed only and only one systematic risk. We took only the benchmark index and ignored all other factors. So CAPM only considers the sensitivity of one systematic risk, that is the market. But my company does not only deal with the movement of the market, it deals with certain other economic macro factors. For example, inflation. It affects my company's business, the prices of shares of my company. Apart from this, the market is the factor. Apart from this factor, there might be the other factors such as the interest rate, exchange rate, GDP, GNP, and there are n number of factors. So there may be 1, 2, 3. In short, there can be number of systematic risk factors that we need to consider while calculating the return, the expected return. But what is the systematic risk? I request you to see this video also on systematic risk and quantification of systematic risk. But in brief, I will tell you that this systematic risk is that risk which is non-diversificable, that is based on macroeconomic factors which includes economic, political, social, that is interest rate, inflation, purchasing. So these are those factors which are to the concern of an investor because they cannot be controlled. Now moving further, what is asset pricing, arbitrage pricing theory, which consider all these macroeconomic factors? That is APT, arbitrage pricing theory. Now the equation of SML, that is the CAPM, was this. So what will be the equation when we will consider the beta of every factor, that is beta of inflation, beta of interest rate, beta of exchange rate, beta of this, beta of this, beta of n number of factors. So our equation in case of APT will be ER or RE, because it is an equilibrium model, is equal to RF plus FRPA beta A plus FRBB multiplied by beta B plus dash dash dash, that is the n number of factors. We will discuss this equation also, but first RF, that is common in both the case, that is the risk-free rate of return. The return that I will be getting in investing my money in the government on treasury bonds where there is no risk. And do you know that beta of this risk-free rate or the government bonds is 0? Plus this. Now what was this? It was this RM minus RF is what? It is the premium. The premium that tells me the compensation that I am receiving for bearing the extra risk. So the equation, now you see FRP A beta A, what is this? So this is what about the different factors. So FRPA, A is our stock. So what this tells me, it is the factor risk premium. That is, for example, I am taking the inflation. So what is the inflation risk premium? That is the inflation RM minus RF multiplied by beta. Beta we already know, that is the sensitivity of a stock in respect to that factor. That factor may be inflation, interest rate, market, or GNP, or exchange rate, or any other factor. So FRP, that is the factor risk premium, RM minus RF of that particular factor, and beta we all know, that is the sensitivity. That is the systematic factors. So CAPM, the point that CAPM ends was that it considers only one systematic factor, and that was the market. But this APT considers all economic systematic macro factors. It is a theory. Now let's understand the name also. It is a theory which helps in the asset pricing. The rate, that is the RE or ER, will be then used to calculate the cash inflows from that project, and then it will be compared with the estimated price, and then it will be helping us in making the decision. But what is the now ER, that is the expected return that we calculate using this theory, is the function. It is the function of systematic factors, that is the macroeconomic factors that we discussed many a times. Now what is the meaning of arbitrage? Why it is called as arbitrage pricing theory? So what is the meaning of arbitrage? In typical words, you will find the exact definition of arbitrage is this one. You can read this. It is the practice of taking positive expected return from overvalued or undervalued securities in the inefficient markets without any incremental risk and zero additional investment. So that was a typical definition of arbitrage. But for us, there is a 3-letter definition of arbitrage that is very simple. The first one is making profits, that we will make profits, we will earn profits. The second word is without any investment. The third is without taking any risk, without bearing any risk. So arbitrage meaning the 3 word, that is making profit, without investment, without risk. So how we make profit? Now arbitrage works on the basis of 2 asset models. So there will be one asset, asset 1, and the other will be asset 2. So one asset will be correctly priced and the other will be wrongly priced. And what will happen? We will make profit. How? We will sell at a higher rate and will buy at a lower rate, and will make profit without investment, without risk. Now, who was the man behind this APT, that is arbitrage pricing theory? So his name is Stephen Ross. Now he was a great man, and he is also known for his binomial theories. Apart from this, his concept of risk neutral, and he was also the president of various organizations and was at MIT also. So that was all about arbitrage pricing